Mastering Cash Flow and Profit in Uncertain Economic Times. It's a bit of a timely one that we've decided to put together. Yeah, we've sort of just focused on inviting a few handfuls of clients. So it's not a big one. We don't have, all our the whole client base, or we didn't put this out to our email database. It was just literally like an invitation to a handful of clients. So welcome to this one, and it is me and Riz presenting this one, although I'm mostly here to look cute. Riz is going to drive this one. Steve almost fell off his chair. Cool. Well, yeah, let's hit that next slide, boss. Cool. Before we get into this webinar, we've got one coming up as well in a couple of weeks, or actually that is in 1 week, all focused on estate planning and asset protection. So we're going to go through all the things that is good to have in place for that stuff next week. If you do want to join for that one, the link is should be in the chat box. There it is. Thanks, Tay, for posting that one. And we will see you next week on the Webby. And next one, yeah, cool. Everyone knows who we are, but cool. Thanks, Riz. Yeah, just a quick intro for me. Started at Inspire when I was 23 years old. I'm an award-winning chartered accountant with 17 years of accounting experience, and the author of a couple of books there. And who do we have joining me today? Mr. Riz, cool. So Riz is a partner of Inspire and chartered accountant. He joined Inspire in 2016, not about new dad. You've been a dad for a little while now.
Yeah, he's almost 2, but by November. So yeah, it's a little bit older than that photo there.
Yeah,
that's it. It's been a really awesome journey with being a new dad, but also giving me some new perspective as well. And yeah, really excited to be sharing a little bit about what I've learned and how that impacts my outlook on business as well, when it comes to growing your own family and having a business as well. But yeah, I guess today you guys are here obviously for a reason, not just to get to know us. So you already know both of us, but we're going to cover a couple key things. There's going to be a bit of a number crunching, and then we're going to see some kind of live examples of how what are things that we can do to help us through this kind of economic downturn that some people are talking about or projecting that's going to come in the next year or so. And what we'll cover today is planning for what ifs, and we're looking at what we can do to increase sales outcomes, lowering costs of sales, managing cash flow as well. And obviously, if you guys need some help after this session, we can obviously help you guys there as well. And before we get started, I just wanted to share kind of a couple of things. Sorry, just skip the slide there. There's some insights that we get from being accountants and being behind the scenes, especially working with big businesses like Xero and Ignition, and we know that if through the Xero Small Business Insights, that more than 90% of businesses in New Zealand, Australia, and the UK experience at least 1 month of negative cash flow each year. Now, that doesn't sound like too much or too crazy, but if we think about having a negative cash flow for a business, it depends on how your situation is, right? If your business is, your cash flow balance and also your balance sheet strength is green and healthy, it's probably not a big issue for that 1 month. But for some businesses, that 1 month could really mean, make or break, and that's it. That's the end of the line for some businesses. So and there's a couple of things that's that we need to be mindful of, especially in a tougher economy, and how things can affect your business, right? And it is not rocket science, but to sustain your business, you need to have the same amount of level of customers or profitability to ensure you maintain your balance sheet health. Now, depending on where you are right now, we could be in a good position, then you can sustain some rough moments or times ahead. But if you're in a bad position right now, this is where it's even more important for us to keep an eye out for some of this stuff, because in a tougher economy, we can expect a few things: fewer customers, fewer inquiries or leads, and you see this kind of economy being quite sluggish. People are not spending money, and that means that people are then considering even harder how to when they're spending their money. So creating leads might be a challenge, but also converting them also is going to be a challenge. In terms of some types of businesses, if you're in physio the world or physio world, allied health world, there's a lot of return business that's required to keep sustaining that business. It could mean that there's less return customers as well. And as people are starting to tighten up, they start thinking about instead of spending $300-400 per week on a shop, they might start picking only the basics. So if you have additional products and services that usually customers would package up and buy from you, or it might be that they only go for the bare bones, so spending less as well. Now, for those big businesses that are there, we know the Woolies and the Coles, and they have the balance sheet to sustain some of this. What they can do to fix that is to reduce prices to attract customers. Now, that's not really an option for some businesses. That might actually make it a lot worse because, again, depending on your balance sheet health at the time as well. Some of the things for those are the businesses that hold stock. If people are spending less, your stock is not flying out the door. It means that you're not only holding more stock, but it could mean that your suppliers also increase the price on that stock as well. So overall, other things that we know that is already happening: interest rates, fuel, wages. Those are things that small businesses are seeing already or have already seen in the last 12 to 18 months, where it might even 2 to 3 years actually, where we've seen this steady rise in other costs as well. So how do we deal with it, right? We need to make sure that we understand first and foremost the business cycle. Now, this is kind of like a kind of one-pager document that shows you how money gets put into a business and how it generates income, and then how that money gets paid out to those initial investors. So the whole idea here is to accelerate the spin cycle to increase the return on your capital. Now, you're already doing this, but this might not have been presented to you in this way. But essentially, where it starts is we think about the owners investing in the business, and then what happens, and they use the capital. The business uses that capital from the owners to invest in assets. Now, these assets might be, things like team members, IP, stock, whatever that looks like. Those assets are then used to generate income, right? Now, when you generate that income, what happens is it turns into profit, as long as you obviously pay your suppliers and things like that. So here's where you can see the gains and the drains, what kind of creates profit and what that drains profit itself. So the profit gains is, you increase your sales growth, your margin growth. Your drains is, you have unchecked overhead expenses. So this is where the game is won or lost in, a simple equation: make more than you spend, right, to make that profit. Now, that's not enough though, that you create profit, because the business doesn't end when you create profit. What happens usually is you reinvest that business because it's a going concern. So the cash that is generated from that business is then important to understand as well. What are the gains and the drains of that for the business itself? So when we look at cash drains, you might create profit, but the profit doesn't come to you in cash. Now, the reason for that is you might have a bigger drain on your cash than gains right now. Some of the things might include slow collection of debtors, increase in stock or work in progress. For accountants and lawyers, they use WIP, they call it. And if you're and even manufacturers, they use WIP as well, and even raw materials and stock there. Now, the other drains as well is, if most of your capital is funded by loans, you have to use some of that profit to repay your loan repayments as well. Now, this does not necessarily mean banks. It could mean tax debt as well, like ATO and things like that. Now, which is the next point there, actually. And also, if you pay your suppliers faster than you collect your income. So the reason for that is profit is not necessarily cash. You could make a profit by issuing an invoice for $10,000, but then you pay your supplier for, you had already paid your supplier first at $5,000, but your customer takes another 30 days to pay that $10,000. So you're out of pocket that 5,000 in that moment, right? So this is what we talk about when we say faster supplier payments here. So those drains are important to keep a check on, because yes, you might create profit, but your cash might not be sitting in your bank account. Now, on the flip side, we've got the cash gains itself. Now, obviously, if we collect faster, in my example before, even better if we collect before we have to pay our suppliers, we don't have to fund that gap through our own cash or balance sheet. Obviously, decreasing stock and work in progress. This creates the effect of the term lockup. You might have a lot of cash sitting on the shelves. Now that's sorry. You might have a lot of cash sitting on the shelf in the form of stock, and you might have already paid for that stock itself. So the longer it sits on the shelf, the more it's locked up, or the longer that your work in progress is not billed, that's the longer that you are not collecting that cash, so straining that cash even further. And then what you can do is slow the repayment of suppliers. So essentially the opposite of that one before, trying to pay after you've pay your suppliers after you've been paid itself. And obviously this is something that we're famous for, reducing your tax payable year on year, to make sure that when you make profit, there's always the ATO at the end with the clip. We want to make sure that clip is as small as possible as well. So you see how this is where sometimes it gets a little bit lost here. That's a pretty simple understanding: make more than you spend, but then how do we make sure that it all turns into cash that we can then either reinvest in the business, so you see the cycle here, or we take out as drawings and enjoy that as distributions or dividends as well. So, or paying back your original investment loan into the business, right? Now, but also remember that this is a wheel. So the way that works then is if you have profit or cash already collected, because of the going concern nature, you want to make profit for the next month or the next year, right? So you got to invest that in assets again, and then turn that into profit. And the cycle goes on and on. Now, the whole game here is to accelerate the spin cycle. So what that means is that you are wanting to turn profit into cash that you can invest, so you can create more profit again. So every time that you turn the cycle, you create profit that you can collect in cash. The faster you turn within, let's say, a set period, right? Let's just put it simply here. If let's say you turn the wheel 10 times, and each turn is $10,000 in cash. Every time you turn that wheel, it's 10,000. You turn it 10 times in a year, then it's 100,000 in cash. Now, if I could do the same thing within 1 year, I turn it 20 times instead of 10 times. Now you can see 200 grand. Now, how does that work? It's really, the idea there is to create profit and turning into cash so that you can then invest. Cash is the important bit. As long as you have cash, you can always invest. Now, obviously, you can borrow and do things like that. That's why for some scaling businesses, they look externally for that cash to then scale up. Now, you obviously can cash fund your own growth by using the profit that you have, and maybe not taking too much money out just yet if you're in that scale up period. So the faster you spin, the more you scale, the more profit, the more cash that you have. You also can spin it at the opposite of it is you don't want to slow the spin down. So if you're at a point of your business where growth is not necessarily your strategy, you want to maintain a healthy spin. You don't want it to slow down, because once that slows down, because it's a wheel, it affects one another, right? So if you have consistent loss months, consistent months of not collecting cash, what happens over time is that you're going to have to fund those losses through your balance sheet, and that slows down even more. So it becomes this kind of snowball of issues over time as well. So I find this really useful, rattling around in my head when I'm thinking about either the clients or even inspire ourselves in making decisions day to day. I need to make more than I spend. It's basic, but I need to make sure that I collect cash, or I have cash in my bank account as much as possible, so I can take the next step and spin this wheel again. So that's a bit of a kind of business cycle 101 that you all are doing actually right now. It's just, sometimes it's not presented that way. Now, another way for us to track all this gains and drains is to use metrics. There's some metrics that some of you might be familiar with, some of you might not be. But essentially, there's a few metrics in that we can track. So you can see here, this is our value gap calculator, and essentially it's a way for us to calculate what we call the cash conversion cycle. So if I go back to this is what we call the cash conversion cycle. It's how quickly we turn our capital into cash and profit. So the idea there is for us to spin the wheel as fast as possible. Now, how do we do that? Now, if we input all the information here, so this is just input. This is an actual calculator that we have, but we're going to run through screenshots today. But if we actually input all this information here, you can see we have 1.2 million in sales, 700,000 in cost of sales, and also there's overhead expenses of about 500 grand. So that's on the profit and loss side. Now, our balance sheet, now this is the cash side of the equation. We have accounts receivable of 218K, inventory or WIP of 194K, and then accounts payable of 116. Now, as you can see, this is an important metric to put in because what we want to see here is what is the impact if we change some levers within the business to improve our cash conversion cycle. What does that do to our cash flow or increase sales? So I'll go through all of that as well. Now, you see that once we put those inputs in there, the calculator spits out for us a few bits of information here. And you can see the cash conversion cycle information down here. So you can see that the debtor days are currently sitting at about 64 days. The inventory WIP days are currently sitting at 101. And the payable days are currently sitting at 60 days. Now, this is from the inputs that we put previously. Now, that current cash conversion cycle is 105 days. Okay. So remember how I said, if we can spin it more times. Now, if it's 105 days, it's pretty long. There's only 362 days in a year. The cash conversion cycle is very long in this instance, right? Now, what we want to do is reduce it as much as possible. So the shorter your cycle, the more cash you have available. Remember, we saw the slow collection debtors, all that problems before. Now, let's see what we can do if, let's say, we move some of this information, some of this levers. What are the things that we can do? So here's the change factor. And you can see if we move those levers here, it's just changing the day. So the idea there is, remember, collecting quicker, delivering work quicker or clearing your inventory quicker, and then making sure that we're not paying our suppliers too early. But in this situation, it looks like it's a little bit too late here. So if we do that, we can move a couple of things to help. Sorry, just check my slides. It's good. Sorry, we'll move on to the profit cycle before we change stuff first. So that was the cash conversion cycle. Now, from the profit section, you can see that there's different strategies that we can implement as well. Now, we know that we need to make more than we spend. So some of the strategies include increasing retention rate, essentially not losing customers, so retain customers, and an increasing number of leads per year. So that's one of our equation: more leads, more conversion, more sales. So then the next one down is increasing our lead conversion rate as well. And then here's transactions per customer and average transaction value. Now, this is for us to essentially impact the sales figure here. Now, where we can see here, this is the 5 ways that we can grow sales. Today, we're looking at the impact if that reduced sales can have on profit. So because what we're imagining here in the future is, if let's say our business goes into this kind of tumultuous time, right? And our percentage change in sales drops by 8%. Retention rate drops by 8%. Now, the idea there is we don't have as many customers coming through the door. For instance, Inspire, we have ongoing clients. If that changes by 8% down, we can see the impact on our cash flow and profit here. So the impact is actually a negative impact. So the total profit impact of reducing that retention rate is by $44,000, which is really painful, but it's such a small change. The idea of this calculator here is that we can show you what is some incremental change across the board that we can do to help reduce reduce the impact of that retention rate issue or increasing your sales. So if we know that we're going to go through a bit of a tough time, what are things that we can do across the board on a marginal level to help mitigate some of those losses that we might be experiencing in the future here. The next thing that we can do is look at, we're painting a bit of a bad picture here, but you can see we can decrease the leads as well. So, and the logic here is that, again, some of the things that we might experience in the next kind of 12 to 18 months is that the phone stop ringing, right? So our leads start dropping. So here in this example here, we're changing leads from 175 to 166. So we've got nine less leads here. So the profit figure we were losing 44K before, now it's dropped to 47, and our cash flows dropped by 33K as well. Let's make it a little bit more kind of nasty. What that can lead into is our conversion rate itself, because it's all linked together there. So our conversion rate also drops. It just means that because it's a equation that's connected, more leads usually relates to more conversion as well. Less leads, less conversion by about 10%. That's less by 22 customers. You can see that our profit drops by 58K now. It's starting to climb up quite significantly here. That we're at cash flow, we're looking at about 41K per annum here. So if we're not keeping in check some of this stuff, right? See, this is another final change here. The transaction value where people are spending less, like I mentioned before, they're picking and choosing what to spend on instead of your packages. They pick just the bare bones. If let's say we drop that by another 10% as well, that's $98 only, but the impact is significant at a profit level. So because that's there's a volume that you times that by a volume figure as well, the profit drops by 100K. So the impact is huge if on small changes across the boards here. And now what we want to make sure is that we have strategies to battle some of this stuff, right? If your customers are looking to buy less, if we're predicting that our customers are not going to stay, their new customers are not going to come through, our phones are going to stop ringing or slow down, and then our existing customers are starting to pick and choose. This is a time that we need to make sure that we go into some strategies to help kind of battle that itself. So before I go forward, there's a lot I kind of rushed through there. I just want to stop kind of for some questions here. See, there's someone asking about recordings. Does anyone have any questions so far?
And maybe just to recap as well, while questions are being popped in, I guess what you're looking to do is sort of demonstrate the effect on profit of a handful of crap things happening in a bad economic environment, or even that last one there, average transaction value down by 10%. That could be reducing your prices by 10% to try to keep clients. So, and then I think the next one is also an overheads increase as well.
That'll be the next section as well. But yeah, so far, I just want to see if there's it's a bunch of things that can happen. I'm not saying all of it happens at once, right? But it can happen on those different levels. I just want to see. Yeah. Caleb, in impact summary, can you explain increase in ROI? Where are you looking there? Oh, increase in ROI. Obviously, that's the opposite. That only happens when there's an increase, not a decrease. So it just means that the return on investment itself. So back to that cycle that I talked about. There's an amount that you put in, let's say 100 grand of initial capital that you put in, right? Now, what's your return on investment on that? Now, if you're spinning the wheel fast enough, you're making profit. So you're making the capital plus profit, whatever that difference is, your return on investment. So let's say if I spin the wheel and make a $10,000 example before, that $10,000 is your ROI. So that's a 10% increase on your, that's a 10% ROI essentially. It's a good question, Caleb. Okay. Cool. All right, so the next section here is, we've adjusted some. That's just a continuation as we scroll down the calculator. There's other sections that we can adjust as well. So that was your sales top line. Think of your P&L. That's your sales factor, right? Now, things that might change as well is, let's say we adjust $10,000. Now, this is a small change in your overhead, right? So it will affect your net profit because obviously, if your rent goes up, your interest rates goes up, your I don't know, cleaning bills of your office goes up. All this stuff start adding up here, and essentially the overheads you can see here changes from. I don't know if we can see my. I just realized people couldn't before. Sorry.
Yep,
so now you can see the change of the overheads goes from 500 to 510,000, and then essentially our net profit. That's because of this impact here as well, has changed from $3,000 loss to 150 grand mainly because of the sales. And you see the net margin changes, a 12% loss itself. So where there's a small change, it can be quite scary to think about this, right? Like, I'm not here to just fearmonger you guys, but where these changes are not new or can already be seen is we can see that there's you see the lag effect of this, or the initial indicators of this is that governments and big organizations start slowing down their spend as well in reaction to all of this. Now, the reason why they react in that way is they're changing their overheads, right? They're trying to reduce the cost of their overheads, also reduce the unnecessary capacity that they have on their books to help reduce this impact. Because at a sale level, at the top line level, the market's going to almost do what it's going to do. It's going to react the way it's going to react, right? So you see a lot of businesses react by not really understanding those levers, and they're just going to chop off some of those expenses that that was there. So you see a lot of layoffs, you see a lot of contractors being laid off, and to save a bit of costs in that section. But we're not here just to talk about how sad it's going to be in the next 12 months. We're here to talk about, obviously, some of the strategies. Then when you look at it, it's not really that complicated, but essentially it's to preempt all this. Now, as you're watching this, you might see different parts of different parts of this strategy that apply to your business. Now, for instance, increasing your retention rate. That's one of the strategies that we talked about. Is it's really a time when we need to engage with our customers and know them a lot more than before, and really understand where, let's say, they are going in their business. Is are they doing okay? Are they those ones that might leave you? They might be the ones that not return and come back, or are they already unhappy? And then really identifying that early and upfront. And ask them, like, what do you want, right? So that proactive approach of, hey, just checking, how are we doing? Is there anything we can do better? Are you experiencing the best service, or is the product that you're receiving what you expected it to be? And you want to obviously under promise and over deliver as much as possible, because that's where that retention rate really happens, because you're delighting your clients and surprising them. Some of the stuff that we've implemented in the last kind of 6 to 12 months is doing some random check-ins with our clients, where we would just give them a call and just say, hey, how are you guys doing today? Yeah, well, no, there's no agenda. I just want to check if everything's okay. And usually what happens there is a bit of a relationship is created, but at the same time, there's an opportunity for you to go, oh, I can help you with that. Or at the same time, they get surprised the fact that they are supported in this area. Now, depending on the type of business you have, if you're in the allied health space, attacking on 5 to 10 minutes at the end of each session, just to get to know them a bit better, rather than just to deliver your service, will help with that increase in retention as well. Now, obviously, you can reward loyalty. Consider offering guarantees, and where you're kind of like Qantas. You have those Qantas points to maintain that retention rate, especially if you're in an industry where the products are quite homogenous. It means that's the same. You go down the street, it's the same products, the one that you have. Really, the difference there is the service that you provide around it itself, or the loyalty program that you have. So encourage long-term clients or long-term customers by giving them either discounts or giving them kind of benefits for being with your business a bit longer. Just checking for time. How are we going for time here?
Yeah, man, we're good. We got 25 minutes left.
Cool. So we're about halfway, which is good. Now, increasing leads, obviously, that's something that is important to do, preempting that as well. We found that even during tough times, you can turn those tough times into opportunities as well. So an example, when Inspire was going through the COVID period with our clients, what we did was we knew as a team we needed to be there for our clients. So we built a really strong online presence where we were everywhere. We were talking about the COVID stimulus. We're talking about the help that the government can give, but just being on the front of your customers, because a lot of businesses are not going to do that, and they're not going to battle. They're going to look internally on what they got to do to survive the tough times. Whereas that's an opportunity for you to get in front of the clients. The other way to do it as well is sales sometimes doesn't necessarily have to be, a cold call or hey, do you want to buy this, or upselling internally. You can also implement a referral program. We found this has been a pivotal strategy for Inspire as well, where you have they're not, if it's a Venn diagram, they cross over a little bit in terms of the services they provide, where you could cross refer, or you could have fee based referrals as well. That's one way to increase your leads. Attending networking events wasn't available during COVID, but we're coming out of it a bit more now. Getting that presence in front of your people, being recognized in front of your peers as well, can create that referral program. So networking events are not just for your customers. It could be also for referral partners that you can go in with as well. We love this education in marketing, like kind of what we're doing here. Really think about what's contemporary, that's coming up. If we're thinking, tough times and tough situations, how can we link that towards our product and service that we deliver, and educate our clients what they can do to essentially avoid that, or reduce the risk, or maintain a healthy relationship with or themselves and their business throughout the kind of tough times that are coming as well. This is something that we've been trying to do, but where I've seen this really successful is building a community and presence as well, where people can share amongst each other what is happening in their world and what they can do and what they can't do, the wins and losses of those businesses. Now, if your customers are, if you're a service-based business, it's really powerful here, because you can get a group of your customers to talk about all the services that you provide by giving them ideas, and you can deliver those education and marketing events within that community as well, where people can join together, turn on the camera, start talking to each other. I find this doesn't only increase leads, because there's situations where people, I'll use Fitstop as an example. They build a community of people who are working out, but on Saturdays they were allowed to bring a friend, right? For instance, and when they brought the friend, that friend became part of the community and kind of grew bigger, bigger, bigger. So it not only can create new leads, but it also can increase your retention as well, that stickiness of your customer to your brand, because they're proud to be part of this community, where whether they're part of that Fitstop community, like I talked about, they're very proud to be attached to your brand, so to speak. Not too far from being a cult, really. Some businesses do get to that point. Now with that increase our leads, we want to make sure that we're converting more of those leads into customers, right? So customers should receive the same awesome experience, no matter who you deal with, right? And you want to ensure that you have a sales process. That's so important, because usually when we talk about leads and the conversion rate being quite low, is because our sales process is a little bit lax, so it doesn't exist. What is the step step-by-step process from a customer or a lead to turn into a customer. We talk about here in Inspire, we talk about laps. So laps being leads, appointments, presentation, then sale. And we link that towards our conversations with our prospective clients. What are the lead conversations that we have? What are the appointments that we have that would present value after that? And then what is the sale or the closing sale itself? And identifying that process and training your team is important because they know from not only it absolves you from having to be on the phone all the time, but it creates a really structured approach for your team members to go through and identify where the issue is. When you break down your sales process really well, you can identify where the problem point is. Is it the leads? Is it the appointments, the presentations, is it the sale? Where is our problem, right? Now, and you might start with nothing, but try to identify what are those the sales process steps right now. So, work backwards from what you're already doing, and then really structuring that for your team to understand. Because there's no point increasing our leads, but then conversions is just not great. The other things that we kind of sprinkle along our sales process is, we want to increase our sale, the S at the end. We offer alternative payment arrangements. We make sure that, we get the sale, right? Remember, it's about capturing that as quickly as possible. We get it, but you can offer alternative payment arrangements. Now, you can talk about zip pays and things like that, depending on the type of business that you're in. Testimonials case studies, super powerful. I find them sometimes underutilized as well. Their stories now, especially, it doesn't have to be new customers as well. It can be even in upselling, talking about stories. Now, some of the things that we've done in the past is we do a bit of a brainstorming idea with our team to kind of go, hey, what are some like wow moments that you've done with your customers where you've delivered great value, but it's something that they didn't know beforehand. You came with the idea and now it's changed their business. And hey, do we have a testimonial from that person, right? And if we do, cool. If we don't, hey, let's go get one. And using that in your sales process, like I said, sprinkling that across that sales process to get that conversion rate even higher as well. This is pretty simple, making it easy. I find it cumbersome, for some businesses to even Google and find where their location is or how to book an appointment. If it takes 10, 20 steps to even just get in front of you, your conversion rate is suffering there. If it's as easy as possible, get in front of you, and you're at the point that you can have the conversation with your customers already. It removes that other barrier. But again, start with your sales process and understand what are some of those challenges. If you have that structure in place, you can kind of see where some of those gaps or some of those issues might pop up itself. The other thing that's underrated as well is just be a secret shopper. If you really want to kind of invest some time to understand your sales process, right? Secret shop. Just go in, book a fake appointment, see how that all works, right? And because oftentimes we're from the inside and we're sending stuff out, we don't see the outcome of our customers and the experience that they have. As a business owner, you'd be evidently clear straight away what are the things that you really want to change in that process. So really powerful way to get some information as well. We've got a few more. I'm going to just going to check my slides here. I'm going to blast through some of this because we've got another 15 minutes. Yeah. Yep. That's quite a lot there. I'm just going to pick and choose some stuff. If you have any questions, feel free to pop them in there right now while I scroll through some of my slides. Cool. All right. No? All right. Awesome. So quick cover. We talk about increasing transaction value, increase prices. Right now, inflation is real. If you're not increasing your prices, definitely do that because your costs are increasing as well. If you've received an email from anyone or any suppliers that say, hey, look, we're increasing our price by X amount or X%, that's a trigger for you straight away because it's linked towards your profit, right? If you're not doing it as well, then you're going to be the one that's footing that bill. So it depends on who's at the bottom of that pile, right? There'll be a business or a couple of businesses that just don't do it. What ends up is they're the ones that's footing the bill for everyone. So you don't want to be there. I'm not saying, increasing it crazy that you lose all your customers either, but we'll talk about discounting in a second, because we don't want to do that. But finding that right market price as well. And there's a whole thing that you can read about this, but there's a understanding your niche and your market and where you are positioned itself. It's important as well to give you that confidence that you are in the right space, and also testing that with your customers. If you've never done it before, you'd be surprised how much your customers actually love what you do. So going through that process at the start of engaging with your customers first will give you even more confidence to do that. But that's a very easy way. What I like about increasing prices as well is that it's the surefire way for it to everything else remaining constant, for you to increase your profit and profitability or reduce your mitigating any losses, because the increasing prices drop straight to the bottom. It doesn't cost anything to do that. Other couple of things: package your products together, offer better payment options, like I said, upsell. In terms of your sales process, is there opportunities where you're asking the question, do you want fries with that, right? That whole analogy of McDonald's. I think they make, like, I can't remember the number, but billions of dollars just based on that question, over the time that they've existed. Because it's just an opportunity to upsell. Now, when we talk about opportunity to upsell, it means not to purposely sell things that they don't need, but what are some opportunities that we're not spotting in our sales process itself that could add that small increase in sales. Now, if we do that over all the transactions that we have in a year, you'll be surprised how much that drops to the bottom in that, as per the value gap calculator that we saw before. So it's not just about getting more cash in your bank and profit as well. One way to do this is obviously to increase more profit, as well as to lower your cost of sales as well. Now, let's ensure you're taking full advantage of any payment discounts, or anything that, if you pay for 12 months, or buying in bulk, or, having a higher transaction for this 1 month, that helps you save a little bit more in cost as well. Or if you've ever been a customer of them in a long time, like you have a supplier that you've worked for over 20 years, it's just like your customers, discuss loyalty discounts, because they are kind of in the same position as you. They don't want to lose you as a customer as well, right? So talk to them about that. What are some things that you can do for me that I can, benefit, that you can benefit as well, as a longer term strategy as we go through some tough times. So yeah, and obviously planning as much as possible is important. Minimizing rework, minimizing any freight that's inefficient if you have to pick up stuff from different locations. Try to bulk deliver your stuff. That's just little bits of cost of sale that you don't need to be spending, especially if we're trying to tighten things up as well. And review your suppliers. I feel like that's something that we just kind of go on and on. That's something that we've done recently at Inspires, really review our suppliers, and we've made a big change to really help with our gross profit margin percentage. And it's through finding, comparing with the market, and also comparing with other available ways of doing what you need to do. So our service is obviously, providing tax advice and preparing tax returns, and obviously all of this as well. We've had to look at different line items, not just one supplier, whether or not we can do this differently at a cheaper rate and still get the great outcome that we want as well. We talk about, in service businesses, you talk about offshoring and things like that. What are some stuff that you don't really necessarily need to spend Australian headcount and Australian cash on, where you can still get that benefit, sometimes even better overseas as well? So really review that as well. This is just a little example of discounting. Now, it's pretty kind of self-explanatory if you go through it, but it's very tempting to offer discounts to increase sales, especially when it's dropping, right? So, however, often you can be more profitable by holding your price and accepting the reduction in sales and volume. So, and it sounds kind of weird sometimes, but it's actually better to do that than to discount. For example, let's say you've been selling something at $10,000 at $100 each with a cost of $60. Yeah, so you're making 400 grand on it, right? Now, if you were to discount your price by 10%, you can see here on the right here, because it's not working. You can see that you discount by 10%, you can see that, yeah, the cost stays the same. You're making 100 grand less, or it will drop to 300 grand itself. Now, instead of that,
your gross profit drops by 25%.
Yes, excuse me. And you can see the decrease in volume instead. So this is a different example. Alternatively, if you accept the drop in sales, you're selling 9,000 thingamabobs at $100, keeping that price, but you're dropping the volume by 1,000, right? So that 9,000 instead of 10. You can see the difference there. Your gross profit is sitting at 360. So it's only a 40 grand difference by doing so. So what this kind of is trying to showcase is that the discount is more dangerous than your sales volume, because your discount also, the other thing that's dangerous about that is it's applied across all your products. So you're assuming all customers will want to pay less, right? Some customers will pay more. It's okay, they're fine with the price. You're just penalizing yourself for no reason. So when we talked about increasing price before, this is another way to apply this. Is not only is dangerous in discounting, the obviously benefit, the opportunity cost that we face if we're not increasing our price, because you again, engage with your customers, understand what that impact might be, especially if you're really good close customers. What does that look like if I increase my price by 10%, right, instead of decreasing? How much of that will actually drop in sales, in volume? Now, more often than not, especially if you've been around a long time, you've got great customer service, your NPS scores are high, you won't even lose that many customers, not even 10%. So we can share our own examples as well, and Spice one through a bit of that as well. But it's because you're not increasing prices because you're doing more. It's because you have to, because things are increasing as well across the board, and you have to do that. Now, your customers that understand that but love your service will retain and stay with you. Now, for those that don't, this is where this example is kind of saying it's okay. We understand. That's just choices that we have to make right now, right? And the difference is, if this is a 40 grand drop, I don't have an example where it's showing how much that would actually increase to the bottom line for you, but you can see it's definitely going to be more than the drop in volume itself. Yeah, pretty powerful stuff there. I know increasing prices is a challenge, can be a challenge. How you come about to arrive to that decision, different for everyone, but from an accountant's perspective, it's something that we need to do in this time right now. So don't be the one at the bottom of the pile. Sorry, Ben, did you want to add something there?
Yeah, just maybe we go high level through this one, like really high level. Yeah, just time left, and I'd love to sort of show that positive scenario and run through what the other side could look like.
So we've seen some strategies of increasing sales and reducing costs, but there's also better ways to manage our cash flow, right? So small changes can result in a significant increase in cash flow over time. Now, in that kind of spinny wheel one-on-one cycle that we saw before, we want to make sure that we manage that as best as possible so that we can reinvest and create more profit, or spin the wheel faster. Just remember that there, right? So things that we can implement to improve, just a few ideas. Make sure that you have a process for data collection, review them. Some people don't even know that they have data sitting there for months, and you go, whoa, that guy's betas. Just review them. And if you don't have the time to debt collect, outsource your debt collection. And before you give any credit, check, are they good people to give credit to as well? Because if they can't pay things on time, they got 80 debts out there wazoo, and you're just one of the other creditors. You don't want to be that person, especially now. Monitor your stock levels for sure. You don't want to be just buying and not really understanding what is actually the optimum amount of stock that you have, because you don't want cash locked up sitting on the shelves if possible. Yes, you can plan for future sales that might come up, but how do we make sure that we have the right amount at the right time as quickly as possible? There's things like just in time stock, and depending on your business, you can do that as well. Budget and forecast. So it's something that I see a lot of businesses do really well is they know how to sell, they know how to make the money, but they don't know how to keep it and then manage that to invest again. So when you set a budget, I definitely recommend setting up the budget more than just 12 months. If you can, you do 24 months, go a bit further. But what you want to do that's even more important than that is have a monthly review. you want to check how you're going with your budgets. Were your budgets too airy fairy? We were gonna make $1 million this year, and no expenses at all. Or was it too pessimistic? Hey, we're not going to make enough money, and just really adjusting their budgets as you go along is important, because then you have a closer finger on the pulse as well. Last bit, control what you're spending as well. As a business owner, sometimes I've seen this, and depending on business owners, the advice we give is you have a personal budget, have an amount that you fix, that you draw monthly from the business itself. Because remember, in that cycle, what goes out in that point doesn't come back in and spin the wheel of the business. So if you're, but I'm not judging to say you should, not enjoy a holiday or do anything and just eat ramen noodles. All I'm saying is have the amount fixed, understand that's the amount. So living within that means at a certain lifestyle that you need, and then build your business around that. Don't use it like a kitty that you can just take money out. It just makes that really difficult for you to plan for the future as well. Cool. I'm not going to go through, there's a whole value gap analysis again for this section of the cash flow, but essentially the gist of this is there's changes, just like the sales section, or the profit section that we saw before. There's changes that you can do in small little tweaks when it comes to your day-to-days, your inventory, and also your stock, your WIP levels, accounts payable and accounts receivable, that doesn't necessarily change the profit, but can change your cash flow, which in turn actually does change your profit in the long term. But in that moment, it can just release cash. Now, the strategies that we want to implement, like the stuff I mentioned here, that release of cash is so powerful, because what you're doing is you're not making cash out of thin air. You're just making sure that you get the cash earlier than everyone else. Because the earlier you can get that cash, the earlier you can invest again and spin the wheel again to create profit again. So the game is to have that cash to fund the next kind of spin, right? Now, obviously, depending on your situation, it could be because you're in a bad situation right now, your balance sheet health is not too good. It's repairing that balance sheet first, right? Bringing you to an even point where you can then reinvest and make more profit. If you're in debt and you're not meeting your debt repayments and things like that, this is the stuff that you're not necessarily creating more profit right now. It's just getting more cash that you can stabilize the shit as well. So that value gap calculator is something that we do with, obviously, as part of what we deliver for our clients. So if you need some help with cash flow and profit improvements, like Ben said at the start, this meeting is only with our clients. We'd love to help you guys there with cash flow and profit improvement meeting. We can book a kind of chat after this to just kind of talk through some of those challenges, because we've covered quite a lot today. You might have some specific areas that you just want to fix, and we can go through that value gap calculator together to find what are the small tweaks that we can push, pull, and release some of that cash and release some of that profit for your business. Now, if we do it before the hard times, the beauty of that is you're building a powerful balance sheet to sustain your business later down the track. Now, if you do it later, look, this is not a bad thing either, but what I'm saying is now is better, because you don't want to be in the throes of an economic downturn where everyone's locking up and you're trying to do this, right? You want to do this now, build a really strong balance sheet, then we'll go through whatever storm that might come up. Might be nothing, might be, totally catastrophic. Who knows? I don't know. If you know the future, please tell me. But I feel this is an important step for you to get to get clear on, understand what are those levers that you can do to improve your business, so that we can weather those storms ahead. So there's a few links. Actually, Austin's in here as well. We didn't actually give a shout out to our team. There's a few team members in here. We've got Rose, Tay, and Austin as well here with us. Austin and I are delivering the profit improvement meetings right now. So if you have you want to book a time with us, obviously, book a chat. Now, if you have never worked with either Austin or myself before, that's okay. Still book it in. We can still have a chat, and we'll work through what are some of those challenges that you might have there. That's it for today. That's me. Q&A. We're going to send you some of this stuff after as well. I think, correct me if I'm wrong, Rose, we have a recording somewhere, maybe?
Yep.
Yes. Yep. Awesome. Thank you. We'll send that across to you. And let's have a chat. If you guys go through if you're going through a hard time right now, how can we improve it? If you're okay, good, how do we maintain it or make it even stronger so that we have a better cash buffer sitting there? And yeah, really want to make sure that everyone's looked after. I don't know what's going to happen in the future, but yeah, there's some not too promising things that we've been hearing going around. Cool. I'll leave maybe a minute or so for any questions. But did you want to share something? Did you say before?
No. Well, maybe while we do that, if you go, have you got the slide numbers there?
Yes.
Yeah, just to paint just a lovely picture. So slide 32
Yep. Yep.
is where instead of having less of each of those measures, it's swung the other way.
Just forget to present to view again. Full screen mode. Share my screen. That one. Sorry,
Beautiful.
that took a while.
Yeah, so I think in the first example, it was all sort of reduced retention rate, reduced leads, etc. This one, this sort of example we've got here is like increasing in retention rate, increasing leads, still a drop in conversion, but not as much, increasing transactions per client, and I think there's a drop of the average transaction value still, but instead of being negative 10%, it's negative 5%. And remember, I think the profit reduced. I can't remember what that was from earlier, but it swings the other way considerably just with a handful of these tweaks.
It was about 52K.
Oh, no, it was negative 112 grand in profit.
Oh, sorry. Yes. As we added all of it up, yeah, it ended up at about 100 grand. Yes.
And so it was swinging the other way by about 125K.
And this is the stuff that, the point of this value gap analysis is just to understand what are some of the small changes. We don't have to focus on 10 different things. It could be just 5% of increasing your leads per year. If that's a strategy that we need to zero in on, cool, let's go talk about it and see what we can do to help your business do that. And then we might stack it up and we might prioritize some of this stuff, but there might be some stuff that's already burning right now that I just want to know about your business. Cool, let's go address that first. And the point of it is it's small changes, not big changes. It's not huge things that will make a big difference. It's those small changes that will really change the outcome overall.
Awesome. All right. Well, there's no questions from anyone, but just a couple of thanks. But thanks everyone for joining.
Cool. And Steve as well. Thanks for joining, Steve.